Hello and welcome to Insurance in Canada. I'm your host, Rick Pineda. So glad you can join me. On today's episode, we're looking at three stories. The first one, a survey indicates that insurance costs are now a factor as to why some people are avoiding electric vehicles. Our second story involves the Financial Services Regulatory Authority of Ontario banning the particular wellness center from conducting business with the insurance industry. And our last story involves the catastrophic weather events in Canada, now revealing many people are underinsured and only finding out about them because of those events. So without further ado, let's take a look at those stories in Insurance in the News. So for our first story for today, we're looking at a survey that was conducted about people's views when it comes to the potential of purchasing electric vehicles and some of the reasons why they are hesitant into purchasing a electric vehicle. So let's take a look. So higher insurance costs a factor in Canadians' hesitation to buy EVs. Higher insurance costs are one reason why Canadians are hesitant to buy electric vehicles, even as Canadian zero-emission vehicle mandate of 2035 draws closer. Per a new Leger survey commissioned by rates.ca, 31% of Canadians surveyed declared an interest in buying an EV, while 49% did not. ZEV, or Zero Emission Vehicle 2025 Q1 registrations were down to just 8.7%, well below the 20% target for 2026. Only 17% of 1,593 Canadians surveyed in an online poll in April 2025 declared an interest in purchasing an EV within the next 5 years. 49% of Canadians surveyed said they aren't interested in purchasing an EV at the moment, while nearly one-third, 32%, said they have no plans for EV ownership ever. While EVs were once seen as an inevitable next step, consumer confidence has shifted, with many Canadians hesitant due to concerns over affordability, evolving insurance considerations, and uncertainty around the long-term costs of ownership. Rates.ca comments on the study results. The hesitation shows why broader adoption may lag without more stable pricing, robust infrastructure, and clear public policy direction from governments. Well, that's an interesting opinion. I don't know, even implementing stable pricing, I don't know how you're going to do that just from the market perspective, and I don't like governments interfering in the markets in that way, especially when it comes to products like automobiles. I don't believe that government should be involved in that at all. Let the market determine which vehicles people want to buy. I never agreed with such things as those EV rebates from governments. Robust infrastructure, yes. Sure, there are charging stations. Range anxiety was always an issue for most people when it comes to electric vehicles, even though for most people, ranges that electric vehicles today can reach would suit most people's day-to-day needs. However, obviously, if anyone looking to go beyond that, range anxiety is always going to be an issue. But even if you were to replace every gas station tomorrow with a electrical vehicle station, there's no way the electrical infrastructure could possibly handle that much demand. So you can try, but it has to start with the electrical infrastructure before developing that, before you can even consider developing any other sorts of infrastructure to support electric vehicles. Clear policy direction from governments. Well, I guess a 2035 mandate that all new vehicles be electric vehicles. That's a pretty clear policy direction, in my opinion. 42% of Canadians surveyed cited the cost of EV repair and maintenance as a major concern, with 21% concerned specifically about insurance expenses. Rates.ca quoted data shows in Q1 2025, non-EV insurance premiums rose 7.8% year over year, while EV premiums surged by 18.9%, nearly 20%, a report on the survey results states. Yeah, that's probably a situation where the insurance companies might have underestimated what the true costs of repairing electric vehicles after an accident would actually be. So, and many insurance companies did offer discounts for having electric vehicles to begin with. So, underestimating your costs as well as reducing the premium you're generating by offering these discounts. And in most of those cases, there was no actuarial reason to offer that discount other than virtual signaling, in my point, to make it seem like, the insurance company was with the crowd that was getting on board with electric vehicles. But that's the end result. These huge surges in premiums from all those actions. Now the chickens are starting to come home to roost, unfortunately. Specifically, concern about insurance premiums for EVs varies by age groups. For example, 29% people between 18 and 34 years old cite insurance costs for EVs as a concern, while only 17% of people 35 and older say they are concerned about EV insurance costs. And yeah, if you're between 18 and 34, that should be a concern because you're going to be paying way more than somebody over 35. Plus, people over 35 tend to have higher incomes than people in the 18 to 34-year-old bracket as well. The study found Canadians between 18 and 34 years old are the largest group of potential EV buyers, making up 41% of those interested in buying an EV. They may be interested in buying that EV. Whether they can actually afford to buy that EV is a different story as opposed to people 35 and older, but that's just my opinion. In a report on its findings, Rates.ca gives an example of how much it might cost to insure a Tesla Cybertruck Beast Crew Cab all-wheel drive. Insuring one in Toronto will set you back about $496 or $5,952 per year in premiums. The report says the quote assumes a 35-year-old male driver in Toronto with a clean record, no traffic violation, and includes both comprehensive and collision coverage. Rates.ca notes claims costs for insurers are higher for EVs in part because of the importance of batteries in EVs. Damaged batteries are expensive to repair and will often result in total losses. And we talked about that in a previous episode regarding how even minor damage to an electric vehicle in an accident can cause the vehicle to be considered a constructive total loss just because the cost to replace the battery pack in many cases will exceed the the value of the vehicle at the time of the accident, and B, in some cases, the value of the vehicle when it was brand new. So those situations where the vehicle is being written off with very minor damage, that would result in a huge steep increase in the premiums to insure these types of vehicles to reflect that. We also talked about in previous episodes another reason that electrical vehicles are so expensive to insure is because of electrical vehicle fires. How electrical vehicles can catch on fire from an accident due to damage to the battery pack, and also electrical vehicles just spontaneously combusting because of some issue in the battery pack that was not seen until the battery pack starts to combust, and the difficulty in putting out an electrical vehicle fire. So add the factor for the minor vehicle damage causing total losses, electrical vehicle fires, and also another factor for the reason for electrical vehicles to be so expensive to insure and to repair is not every body shop is prepared to repair an electric vehicle. Not every body shop is prepared to receive a damaged electrical vehicle because they are concerned that the vehicle could catch on fire. And if it does, they do not have the ability or the resources or facilities to try and put out that fire. And B, they don't have the people trained to repair an electric vehicle or to safely work on an electric vehicle with the amount of energy stored in an electric vehicle. You need to have the facilities in order to properly and safely repair an electric vehicle. And not every body shop is prepared to put in the money, time, and personnel to be trained on how to repair electric vehicles. They just don't see it worth their time. So if the number of facilities that is prepared to repair an electric vehicles is smaller and smaller, if that pool of options becomes smaller and smaller, those ones that are prepared, and it's usually the vehicle dealerships that are prepared to work on the vehicles that they sell to deal with the accident damage. Those facilities, they would be charging a premium in order to do that. So the cost to repair an electric vehicle would be higher just because the expertise that's needed and facilities would be reflected in the bill that's going to be presented to the insurance companies. So lots of factors to consider when it comes to the increase, the year-over-year increase that we saw earlier in the article, the 18.9% premium increase year over year. And I honestly, at this point, I don't see that really coming down. Maybe for internal combustion engines, I talked about the 7.8% year-over-year increase for the rates. Their potential for that to decrease is there, but for electric vehicles at this point, no, not yet. Anyways. Next article. FSRA bans clinic, citing its ties to clinic suspended for insurance fraud. Ontario's financial regulator has revoked the license of a healthcare provider, accusing it of providing the regulator with false information to obscure its ties to a clinic that had its license revoked for providing fraudulent billing to insurers. The Financial Services Regulatory Authority, and for those of you who don't know, that's the authority in Ontario that regulates insurance companies, insurance agent, insurance public adjusters, as well as credit unions and other financial institutions. FSRA revoked the license of Warden Wellness Center Limited, imposed an administrative penalty of $10,000 on its principal, Anusuya Gobinathan. Warden Wellness provided false, misleading, and incomplete information to FSRA, and its past conduct affords reasonable grounds for belief that it will not carry out its business in accordance with the law or with integrity and honesty, FSRA states in a June press release announcing the penalty. In a notice of proposal issued in September 2024, FSRA cited Warden's ties to Gibson Wellness Center, Inc. and Gibson Wellness Group Limited, which had their licenses revoked in December 2023. The Gibson clinics were represented by Thavin Daraja Krishnan. Gobinathan applied for a license as a healthcare provider about a week after Gibson Wellness had its license revoked and an administrative penalty was levied against its principal owner, Thavin. Healthcare providers under Ontario law must submit to billing to insurers using an electronic billing system known as Healthcare for Auto Insurance, HCAI. FSRA issued its penalties against Gibson and Thavin for causing serious economic harm by submitting fraudulent invoices and charging insurers for services not provided, as FSRA states in its notice of proposal regarding Warden. The regulator accused Warden and its principal, Gobinathan, for failing to disclose its ties to Gibson on its licensing application. Specifically, FSRA states in its notice of proposal, Warden Wellness has taken over the business of Gibson Wellness, which were subject to revocations by FSRA. Evidence of this includes, and I'm not going to list all the evidence there. When regulator interviewed Gobinathan, FSRA says she could not answer why Thavin's name still appeared on a door inside the premises of the Warden Clinic, nor could she answer how HCAI worked, which, as the regulator noted, is a key component of the license or the legal responsibility of a clinic's representative. So there's many sources of fraud, insurance fraud, not only coming from the insureds themselves, the claimants themselves, but also fraud being committed by the service providers to the insurance industry. We saw a few weeks ago, I covered in articles talking about the arrest of 18 people in Ontario regarding to tow truck fraud or fraud being perpetrated by a tow truck company, not only against the insurance companies, but also violence against other tow truck operators. Fraud being committed by body shops for overinflating repair costs, and of course, fraud being perpetrated by healthcare providers as well. In fact, there was a article back in 2019, which is the most recent numbers I can find anyways, that stated, according to the IBC, the annual bill for medical services fraud in the province of Ontario alone is approximately $1.6 billion. Countrywide, the financial losses are much higher, and the problem is getting steadily worse. The IBC, which represents over 90% of the insurance industry in Canada, has identified medical services fraud as a top priority as carrying out various enforcement strategies to try and reduce the problem. And this was back in 2019, so it's 5 years later, and there's still the issue when it comes to dealing with fraud from the medical service providers as well. So it's gotten better. Like I said, since 2019, the insurance industry has focused on medical service providers. So I don't see these stories about suspensions when it comes to medical service providers as often as we did like prior to 2020, but it still appears every now and then. And yeah, it's kind of bad when the principal of the wellness center that they were investigating couldn't even describe how the billing system to insurance companies worked. So that's pretty much a dead giveaway that they're probably not that involved in the business itself. So, but it's good to see that FSRA is coming down on these organizations, because fighting fraud is always a key component in trying to reduce insurance premiums, whether we're talking about automobile insurance, property insurance, other types of health insurance. Fraud is always going to be an issue, and it's always going to be a never-ending battle, but it's one that has to be fought regardless. And our last story deals with the topic of underinsurance, or specifically when it comes to property insurance, the limits being indicated on your policy not being sufficient to cover your losses. And unfortunately, many times this is only discovered when there is a claim situation, and the weather events that have occurred over the last few years have highlighted this. So, Catastrophic Weather Unveils Underinsurance Crisis, IBC reports. Many firms thought they recovered until it was too late. As climate-driven disasters intensify across Canada, businesses are facing a growing risk that many did not anticipate until it was too late. Underinsurance. A recent wildfire in Jasper, Alberta has spotlighted the issue, revealing how inadequate insurance coverage left numerous small businesses financially vulnerable. According to the IBC, Insurance Bureau of Canada, many firms in the area were insured below their replacement value and had only 12 months of business interruption coverage, a duration often too short to recover fully after a catastrophic event. So when it comes to businesses, it depends on whether the business is the owner of the unit or building that they operate out of, or whether they're the tenant. If they're the tenant, then obviously they shouldn't be responsible for the building coverage, just the coverage for their own content, equipment, liability, crime coverage, business interruption. If you are the owner of the building, then obviously the limit, you would have to be insuring the building and providing adequate coverage to insure the building. The problem is trying to figure out how much that is. There are ways to try and calculate that. The problem is when it comes to inflation, especially recently with all the tariffs being imposed on Canada by the United States, and a lot of our building materials do come from the United States. It's caused an issue trying to adequately ensure that the replacement value on the policy itself, or say a particular building, is still adequate, taking into account now all these tariffs that have increased the building material costs beyond what we normally experience from year to year inflation. Business interruption coverage, yes, most of the time business interruption, depending on how it's set up. Normally it's 12 months indemnity, so from the time of the loss, it's will cover for the loss of business income, depending, like I said, depending on what coverage form it's used. But default is usually 12 months. Whether your business can be back up and running in 12 months depends on where you're located and what kind of loss you suffered. A relatively minor loss, minor incident, sure, 12 months you can be back up and running, but a large catastrophic type loss, such as a big weather event that's going to cause delays in trying to find someone to come in and repair the damage, especially if you're out in a more rural location, which will cause even further delays to try and find somebody to come out and look at the damage to your property and deal with the damage to your property. 12 months in your situation, even for a minor incident, may not be enough. The Jasper fire isn't an outlier, it's a warning, wrote Cecilia Omole, manager of commercial policy at IBC, and Rob DePries, National Director of Consumer and Industry Relations at IBC. In 2024, insured losses from extreme weather events, including the Jasper wildfire, Calgary hailstorms, Ontario flooding, and Hurricane Debbie's remnants in Quebec, reached a record $9.2 billion. Estimates for the first half of 2025 suggest insured losses have already surpassed $1 billion. Many businesses already strained by inflation, labor shortages, and unstable supply chains are making difficult budgetary decisions. Insurance is often viewed as an expendable cost despite being vital for recovery and growth. It's an expendable cost until the claim occurs. Then you realize maybe it wasn't that expendable after all, because that's the type of cost that's going to help you get back into business, as opposed to trying to see insurance as something you need to tolerate but not prioritize. No. Insurance, and especially insuring to full value and taking the time to look at what you're actually covered for and ensuring that those limits are sufficient to cover what your, say for instance, your equipment stock cost would be right now today, as opposed to what it was 6 months ago or 9 months ago, is pretty critical. I know everybody's busy. I know it takes up time, but this is, after the claim is not the time you need to review that. That's something you should be doing at least annually when you get your renewal policy. Take the time to look at those limits to see if that is actually sufficient to cover what you need to cover today. Here's the paradox, Omole and DePries said. The same factors that may be prompting businesses to reduce coverage are the very reasons why they need more robust coverage. A key concern lies in the standard business interruption coverage, which typically lasts 12 months. IBC warns that reconstruction often takes much longer, up to 36 months in some cases for larger buildings for sure. Due to higher construction costs, labor shortages, and permit delays, when coverage ends prematurely, businesses may be left without financial support. The IBC urges businesses owners to act now while Canada's commercial insurance market remains competitive. According to the insurance broker Marsh, rates fell by an average of 3% in Q1 2025, providing an opportunity to revisit policies. Yeah, but like I said before, don't just revisit your policy just because you're shopping around for a cheaper rate. That, like I said, even if you're happy with the renewal rate that your current insurer is offering you, you should still review what you have on your policy. And like I said, that's the time to make sure that it is sufficient to what you're trying to cover. IBC recommends businesses take several steps: update property valuations, explore extended interruption coverage, understand co-insurance clauses, and make insurance part of annual business planning. Co-insurance clauses, if you're not familiar, those are clauses to ensure that the insured is insuring to at least a certain percentage of the replacement value of the property that is being insured. Sometimes You don't see it too often these days, but sometimes businesses will not insure, say, a building to its full value in order to save, in order to save premium. They assume that any loss that they will experience will not be a complete loss, but only a partial loss. So if they think that they only insured the building to 50% of its value, that limit that's going to be provided will take care of any partial loss that would occur to the building. Basically, they're gambling that the building wouldn't experience something that will cause the total loss of the building. But with the co-insurance clause, if the insured didn't insure it to its least the percentage that's indicated in the clause, 80%, 90% of its replacement value, then the amount that the insured would receive would be less as well to coincide with the actual amount. Because insurance companies, when they calculate their rates to insure a certain particular type of building, a particular type of area with a particular type of use, they assume that the insured is going to be insuring it to its full value. If the insured doesn't, then the premiums that the insurance company receives will be less than they anticipate, which may cause the amount that they're going to pay out in claims to exceed the amounts they receive in premiums, which will cause rate increases in following years as well. So that's what the co-insurance clause is there to ensure that the insured is insuring to at least a certain percentage so that the insurance company is receiving the adequate premiums they need to try and insure to stay in business and keep their rates from having to be spiked too high to account for people underinsuring their property. A business continuity plan and regular consultations with insurance professionals are also advised. In today's world, underinsurance is a bigger risk than many business owners realize. IBC warned, no one expects a disaster, but when disaster strikes, the time to check your coverage is already behind you, which sure words that have never been spoken. But it's not just when it comes to business insurance, but on the personal line side as well for homeowners, condominium unit owners, tenants. You also need to ensure that the limits being insured for on your policies are also adequate to cover your property, to cover your house, especially if, but for some reason, you have a policy that only offers actual cash value on the building. Then it's even more important to ensure that you have sufficient limits, just because you're not receiving the replacement cost for that particular building. But business insurance, industrial, any type of commercial, personal insurance, any property insurance, make sure you take a look at your policy. Don't just look at the premium, look at what the actual limits are and ensure that they are sufficient to cover what you need to take into account all these increase in building costs as well. So that's it for me for today. I want to thank you for joining me. If you like what I do here, please like and subscribe for more. Also, don't forget to follow Insurance in Canada on X. And until next time, bye-bye.